In 2006, millions of people signed contracts that looked like stability and behaved like a countdown. The dream was simple. Buy a home, lock in a monthly payment, build equity, build a life. That's what housing was supposed to be. The safe choice, the responsible choice, the boring choice. But in 2006, housing wasn't boring. It was a furnace. Prices climbed so fast that even the word expensive started to feel outdated. A house wasn't just a place to live. It was a ladder. It was a bet. It was a plan. And the plan was built on a sentence that sounded harmless, almost friendly. This rate is adjustable. Adjustable, flexible, modern, like it's adapting to you. But when your mortgage adjusts, it's not your rate that adapts. It's your life. That's the paradox of 2006. Housing was sold as security, but the engine driving the boom was powered by loans designed to become more painful over time. If you stop listening to the slogans and start reading the math, you see it clearly. Millions of households didn't buy homes with long-term affordability. They bought them with short-term discounts and a promise that tomorrow would be kinder than today. And that promise is what turned adjustable rates into fixed pain. The trick wasn't complicated. The trick was psychological. Focus on the payment you can make right now, not the payment you'll be forced to make later. Keep your eyes on the monthly number at the top of the page, not the reset clause buried in the middle. Keep your mind on the housewarming party, not the date the teaser rate expires. A teaser rate is a sedative. It calms you long enough to sign. In 2006, the teaser wasn't a side feature, it was the product. 2 years low, then it adjusts. Sometimes 3 years, sometimes 5. But the most common was brutal in its simplicity. 2 years of manageable payments followed by decades of uncertainty. And the uncertainty wasn't random, it was engineered. The loans didn't might get more expensive, they were designed to get more expensive unless you escaped. That escape had a name, refinancing. Refinancing became the unspoken foundation under the entire boom. You didn't need the mortgage to work for 30 years. You needed it to work long enough for home prices to rise so you could refinance into something safer, or cash out some equity, or sell to the next buyer, or flip the house, or trade up. The mortgage wasn't a long-term commitment. It was a bridge. And nobody asked what happens when the bridge ends in midair. Because optimism was the fuel. It was everywhere. It was in the commercials. It was in the headlines. It was in casual conversations at work. It was in the way people talked about housing like it was gravity, like it could never reverse. Home prices only go up. Say it enough times, and it stops sounding like a prediction. It starts sounding like a law. And once it becomes a law in your mind, the adjustable part doesn't feel dangerous. It feels temporary. It feels like a detail that belongs to the future version of you, the version that's richer, more established, more secure, the version that will refinance. In that atmosphere, adjustable rate mortgages weren't sold as risky. They were sold as smart. Why pay a higher fixed rate, the argument went, when you can pay less now? Why waste money on stability when you can use that savings to live, to invest, to breathe? The problem is that the savings were often an illusion. The low payment wasn't proof of affordability. It was proof of a discount. It was the calm before the reset. And in the worst versions of these loans, even the calm was fake. There were loans where you could choose your payment each month. The minimum payment option sounded like freedom. It let you pay less than the interest, which means the unpaid interest didn't vanish. It got added to your balance. Your mortgage grew while you paid it. Debt that multiplies quietly while you sleep. That's not home ownership. That's a trap dressed as flexibility. And the system loved it because the system wasn't built around whether you could pay. It was built around whether the loan could be made, recorded, packaged, and sold. That's where 2006 stops being a story about individual choices and becomes a story about incentives. Because the people handing out these mortgages were not always the people who would suffer when they failed. A mortgage broker got paid when the loan closed, not when it was repaid. The payday was the signature, not the outcome. So the incentive was clear. More loans, faster loans, bigger loans. And if the borrower struggled later. That was someone else's problem. That was the bank's problem, or the investor's problem, or the next buyer's problem. The lenders, too, increasingly treated mortgages like raw material rather than long-term relationships. They didn't need you to be stable for 30 years. They needed your loan to exist long enough to be turned into something else. Because by 2006, the mortgage itself wasn't the product anymore. The product was what the mortgage became after it left your hands. A loan could be bundled with thousands of other loans and transformed into a security, a mortgage-backed security. And then those securities could be sliced into layers, called tranches, each one labeled with a different level of risk. The top tranche got paid first and was declared safe. The bottom tranche took losses first and was declared risky. And the middle tranches lived in a fog of polite language. This was the alchemy of the era. Risk didn't disappear. It was rearranged. It was hidden behind structure. It was made difficult to track, difficult to understand, and therefore easy to ignore. Complexity isn't neutral in finance. It's a weapon. It's camouflage. It creates distance between cause and consequence, and distance makes people brave. Once the loans were packaged, they could be sold to investors around the world, and not just gamblers, not just hedge funds. Institutions that were supposed to be conservative bought them too. Pension funds, insurance companies, banks. Money that belongs to ordinary people, money meant to be stable, money meant to grow slowly and safely. How did those institutions justify it? With ratings. Credit ratings became the stamp that allowed risky debt to masquerade as safety. If a security received a high rating, it could be treated as high quality. It could be purchased by funds that were required to hold safe assets. It could be used as collateral. It could be woven into the fabric of the financial system like a trusted thread. And once that happens, the mortgage market is no longer a local affair. It's a global machine, a pipeline that starts with a family signing papers in a suburban office and ends with a pension fund across the ocean collecting interest from that family's payments. And somewhere in the middle, someone gets paid at every step. The broker gets a fee, the lender gets a fee, the securitizer gets a fee, the rating agency gets a fee, the traders get bonuses, the executives get stock options. The machine hums, and everyone watching it assumes that a humming machine is a healthy machine. But the machine wasn't healthy. It was leveraged. It was fragile. It was balanced on the assumption that housing prices would keep rising because rising prices made everything look like it was working. Rising prices covered mistakes. Rising prices turned bad loans into good outcomes. Rising prices made refinancing possible. Rising prices made default feel unnecessary because you could always sell. Rising prices made lenders confident. Rising prices made investors complacent. Rising prices made everyone feel smart. And then 2006 arrived, and the market hit a kind of peak, not just in price, but in structure, in the sheer number of loans that could only survive in a world where refinancing was always available. Here's the part that turns the story from messy to inevitable. The most common teaser periods were 2 or 3 years, which means if a massive wave of adjustable rate mortgages was issued in 2005 and 2006, then a massive wave of resets was guaranteed to arrive in 2007 and 2008. It was scheduled. The crisis wasn't a lightning strike. It was a calendar. And in 2006, most people weren't thinking about the calendar. They were thinking about the keys. They were thinking about the backyard. They were thinking about finally owning something in a world where wages felt stuck and everything else felt like it was slipping away. For many families, it wasn't greed. It was desperation wrapped in hope. The sense that if you don't buy now, you'll be priced out forever. The sense that this is your only shot. The sense that housing is the one asset you're allowed to own that can actually change your future. And the system exploited that feeling perfectly. Because an adjustable rate mortgage doesn't just sell you a house, it sells you a story. The story says your income will rise, your career will progress, your house will appreciate, your credit will improve, your options will expand. The story says the future is brighter, so the loan will be easier. But the loan is not built on stories, it's built on rates. And when those rates reset, the story meets the math. A reset is simple. The introductory rate expires, and the interest rate adjusts to a new level based on an index plus a margin. The details vary, but the effect is often the same. The payment jumps, sometimes a little, sometimes a lot, sometimes enough to turn a manageable budget into a crisis overnight. Now imagine that happening not to one household, but to millions in the same window of time. If home prices were still rising rapidly, the resets would have hurt, but the exit would have remained open. People could refinance, people could sell, people could escape. But when the market slows, the exit narrows. When prices stop rising, refinancing gets harder. When prices fall, refinancing becomes impossible for many. When credit tightens, even those who could refinance find the door locked. That's the loop that broke, because the entire housing boom was built on easy credit. Easy credit created demand. Demand pushed prices up. Rising prices made lenders and borrowers feel safe. That safety justified even easier credit. It was a circular mirror, a feedback loop dressed as prosperity. And then, as defaults began to rise, the mirror cracked. At first, the cracks looked small. A few missed payments, a few foreclosures, a few headlines. But markets don't wait for a flood to react. They react to the first sign that the dam might not hold. Investors started asking questions, the kinds of questions that a confidence-based system cannot survive. What's actually inside these securities? How many of these loans are subprime? How many are adjustable? How many have minimal documentation? How many borrowers have no equity? How many are already behind? How correlated are these risks? And the moment those questions are taken seriously, the whole system starts to reprice itself. Because risk that was hidden becomes visible, and visible risk demands compensation. Credit spreads widen, liquidity dries up, banks become cautious, lenders pull back. Refinancing becomes more difficult, the market tightens. Now the borrower who relied on refinancing reaches the reset date and discovers the truth. The mortgage was never meant to be affordable forever. It was meant to be affordable long enough for the system to pass it along. And when the system can't pass it along anymore, it drops it. That's the moment the pain becomes fixed. Because once you fall behind, the fees begin. Late fees, penalty rates, legal notices. The loan becomes more expensive precisely when you're least able to handle it. The treadmill speeds up when you stumble. And here's the cruel geometry of falling home prices. If you owe more than the house is worth, you're underwater. Underwater borrowers can't refinance easily because they don't have equity. They can't sell without bringing cash to the table, which many don't have. And they can't simply wait it out if the payment is jumping beyond their income. So they face a set of bad choices, not good ones. Pay a payment that no longer fits your life. Drain savings. Take on credit card debt. Borrow from family. Work a second job. Cut essentials. Hold on. Or stop paying and accept the consequences. This is the part of the story that gets flattened into abstract terms like delinquencies and foreclosure rates. Those words hide what it actually looked like. The moving trucks, the empty driveways, the notices taped to doors, the half-finished renovations abandoned mid-project, the lawns that stopped being mowed, the neighborhoods that started to feel haunted. And while that was happening on the ground, something worse was happening above it. Because the mortgages had been turned into securities, and those securities had been used as collateral inside the financial system. They sat on balance sheets. They sat inside the funds. They sat inside banks. They were woven into the plumbing of modern finance. When their value became uncertain, everything that depended on them became uncertain too. This is where a housing crisis becomes a financial crisis. Not because houses are magical, but because finance is interconnected. A bank that doesn't know what its assets are worth can't be trusted. A bank that can't be trusted can't borrow cheaply. A bank that can't borrow cheaply can't lend. A bank that can't lend becomes a threat to the system. And once banks start distrusting each other, the system stops behaving like a system and starts behaving like a crowd. Everyone tries to protect themselves at the same time. Everyone sells what they can. Everyone hoards liquidity. Everyone tightens. That tightening feeds back into housing. Credit becomes harder. Buyers disappear. Prices fall further. More borrowers go underwater. More defaults occur. More securities lose value. More balance sheets weaken. The loop spirals downward. And in a downward spiral, the people at the bottom feel it first and hardest. The borrower doesn't get to negotiate with the bond market. The borrower doesn't get to call a meeting with a rating agency. The borrower doesn't get to restructure the system. The borrower just gets a new payment amount and a deadline. Adjustable rates. Fixed pain. Then came the second uncomfortable truth. The distribution of consequences. When the machine ran hot, wealth appeared everywhere. Paper wealth. Home equity lines. Cash out refinances, rising valuations, bonuses, growth, celebration. But when the machine broke, the losses did not land evenly. Families lost homes, not just as assets, but as anchors. A foreclosure isn't just a financial event. It's a rupture. It changes where your children go to school, how stable your work life is, how you view your own future. It shatters trust at the most personal level. Communities lost stability. Foreclosures don't occur in isolation. They cluster. They spread. They turn one abandoned home into a signal for the whole neighborhood. They pull down prices. They alter crime rates. They change how people feel walking down the street. Workers lost jobs as the crisis spilled into the wider economy. Construction slowed. Spending declined. Credit tightened. Businesses cut back. Layoffs arrived. The crisis, once confined to mortgages, spread into everything. Meanwhile, many of the institutions at the center of the chain did not face the same kind of finality. They faced rescue programs, emergency lending, mergers, and backstops. They faced balance sheet support and policy interventions designed to prevent total collapse. This is the architecture of modern finance. It can socialize losses at scale because the alternative is systemic failure. And that creates a moral distortion. Profits are private during expansion. Losses become public during collapse. That doesn't mean every institution was evil and every borrower was innocent. Reality is messier. But the incentives were real. The structure was real. And the outcome revealed what the system prioritized. Stability for households was optional. Stability for markets was mandatory. Because households can fail one by one, markets fail all at once. That's why the language surrounding 2006 is so carefully chosen. People say housing bubble like it was a natural phenomenon, like a storm, like something that just happens. But bubbles are built. They're engineered by incentives, policy choices, and financial innovation. They are inflated by narratives and defended by institutions until the story collapses under its own weight. And the story of 2006 was simple. Housing is safe, credit is easy, and the future will be richer. The adjustable rate mortgage was the perfect instrument for that story, because it made today feel affordable and tomorrow feel irrelevant. It borrowed optimism from the future and spent it in the present. Then the future arrived, and optimism didn't show up. So what is the lesson of Housing 2006? Adjustable rates, fixed pain. It's not just beware arms. It's not just don't buy what you can't afford. Those are neat lessons, but they're too small. The deeper lesson is how modern systems manufacture comfort. They minimize today's visible cost and push tomorrow's cost into fine print. They build products that only function in perfect conditions, then market them as normal. They rely on the assumption that the exit will always be open, that refinancing will always be available, that prices will always rise, that liquidity will always exist. That is not unique to housing. Governments roll over debt, corporations roll over debt, households roll over debt. The system runs on continuous refinancing, continuous confidence, continuous motion. And the moment that motion slows, the moment the rollover stops, the moment confidence wavers, the entire world looks different. In 2006, the danger wasn't just that rates were adjustable. The danger was that the system was built so that adjustment could only flow in one direction. When times were good, the upside flowed upward through fees, bonuses, and asset appreciation. When times were bad, the downside flowed outward through foreclosures, unemployment, and shattered balance sheets. Flexibility for institutions, finality for families, adjustable rates, fixed pain. That's why affordable might be the most dangerous word in finance, because it often means affordable under perfect conditions, affordable as long as nothing changes. Affordable as long as refinancing remains easy. Affordable as long as markets stay liquid. Affordable as long as the story stays true. Perfect conditions don't last. And when they break, you learn what was real. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.